Charles Hugh Smith, founder at of2minds.com, the website which is routinely featured on zerohedge.com. Thanks to its incredible independent research, just gave us an incredible interview, full of insights as to the wealth gap in America and how runaway inflation is pretty much inevitable. It's a must listen. Make sure you know exactly what the greatest threat to the US dollar that mainstream media isn't reporting on is. Go now to portfoliowealthglobal.com/CaliCoin. It's essential reading from Tom Beck, founder of the newsletter. Enjoy the interview.
Welcome to the Leaders of Tomorrow show at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today we are speaking with an accomplished author, a blogger, and a very popular YouTube personality, Mr. Charles Hugh Smith. Charles is the author of the very popular alternative financial site blog called Of2Minds. Charles has written 11 books on our economy and society, including Why Our Status Quo Failed. His work is published on financial websites including Zero Hedge, Peak Prosperity, and the Kaiser Report. As summer is winding down to a close, we are headed into September, which is historically the worst performing month of the year for stocks. And we will be covering a number of critical topics today with our guest to have him share his expertise. Charles, welcome to the show. How are you today?
Thank you very much, Michelle. Yes, I'm doing fine, and appreciate the invitation to be on your program.
We are thrilled to have you here. We'd like to start off with something called the Misery Index. With inflation at subdue levels and unemployment at decade lows, the Misery Index is very low also, meaning that the economy is booming. But this does not paint the entire picture. Both Tom Beck, the founder of Portfolio Wealth Global, and Ray Dalio, the founder of the world's most successful hedge fund, are publishing content about this very topic, the wealth gap in America, two very different economies. So, Charles, what is the Misery Index and what is it actually used for?
Well, that's a great question, Michelle, and I recently wrote about the Misery Index because the Misery Index was started in the presidential campaign of 1980. I believe it was President Reagan who mentioned the Misery Index and defined it as the unemployment rate and inflation rate. And so at that point in America's history, they were both very high. Unemployment was really high because of the recession in the late 70s and early 80s, and inflation was also quite high. So the Misery Index was quite high. By that definition of the Misery Index, unemployment and inflation, then, as you say, now those are both at historic lows. So in my recent article, I suggested that the new Misery Index would be a little different. It would be real wages. In other words, the wages of the median wage adjusted for inflation. So in other words, the real, whether you're really gaining ground or not, if you got a raise or not, and the labor's share of the gross domestic product, the labor share of the economy, as opposed to corporate share, corporate profits, government, and so on. And so if you look at those two statistics, you find a different picture, that real wages for the majority of American workers have actually declined or stagnated for the last 10 or even 20 years. So people are not making more money. And then if you look at the labor's share of the GDP, in other words, the people, wages and salaries, your regular working people, middle class, working class, their share of the economy has been declining for the last decade. And so more money is going to corporate profits and so on than to actual people working. And so by those measures, we do have economic misery. And as you say, it's not across the board. It's the bottom 80% of American households are seeing their income stagnate, and it's harder to get a secure job. But the top, say 20%, and Ray Dalio said the top 40%, but it's actually more like the top 5% is really doing well, and everybody below that is suffering. And so the key point here is the economy's giving less money to people who are working for a living, and it's giving more to people who are basically investors or speculators.
You know, Charles, the ever-growing wealth gap in America is an important topic, and we cover it at portfoliowealthglobal.com/bonds. Our free exclusive PDF report covers the major issues caused by division and the inequality within the United States. The report is for the upcoming droves of baby boomers who are looking to retire comfortably. Charles, in your overview of the current statistics in regards to wages, inflation numbers from governments, the labor participation rate, and other key data, what do you see?
Well, it's a great question, and I think my basic perspective is that the U.S. economy is also divided, and that's why we have the wealth division, is that for the people who are have the skill set and the education and the experience to benefit from the high tech sectors, the globalized exposure in the U.S. economy, and the sort of financialization speculative boom, the people who have those skills and have that capital are doing extremely well. And they've never done any better, But the people who just have a regular job, they're not getting exposure to those huge capital gains and that kind of financialization benefits. And so they're seeing the downside of globalization, and so offshoring of jobs and so on. And so we haven't really figured out how to solve those big divides. In other words, how do we rejigger our economy so that the benefits are more widely shared? And people are talking about just brute force, like universal basic income, like raise taxes on the so-called wealthy, which of course includes a lot of people, depending on how you, if you happen to live in a place where your house has gained a lot of value, you might be considered wealthy and see your taxes rise. But anyways, the idea is, we'll just tax the rich and we'll give everybody $1,000 a month in universal basic income, and this will help resolve the issue of wealth inequality. But I've written a book called Money and Work Unchained, where I examine that issue. And really what people want is, they want to contribute, they want a decent job. They don't really want welfare, I mean, that's the truth. The human nature, we want to participate, we're social animals, and we want to add value. And so just giving people free money is not really a solution to our problem. And the other thing is, we're not really sure it's affordable to be giving all that money away, and where's it going to come from? And so how do we tackle this issue? And then you mentioned the baby boomers retiring, and one of the issues is capital, by which we mean not just cash, but investments, stocks, bonds, small businesses, acres of forestry. I mean, there's lots of things that qualify as capital, right? And the people who own capital have been doing extremely well in the last decade, and the people who have been relying on their labor have not done so well. So what we really want is an economy where everybody has a chance to acquire capital. That's how you get over the wealth divide, is you allow people a chance to acquire their own capital, be it starting with a house or some investment. And so that's the issue too, is that when you look at the wealth divide, which your report speaks to, is most American households don't have much savings and they don't have a lot of capital. So that's partly why they're not exposed to any of the gains in the U.S. economy.
Charles, staying with the topic of inflation, it's one of the major subjects that we cover in our newsletter, and Tom has actually generated a wealth library to help our audience of investors to prepare for this by sharing his own model portfolio allocation for everyone to see at portfoliowealthglobal.com/portfolio. Charles, is inflation inevitable? In other words, we have seen the QE reach the hands of Wall Street, big banks, corporations, but not trickling down to Main Street, as you were just speaking of. Have the debt levels increased faster than the general economy? And is the USD even a national currency anymore, in your opinion, with 50% of it being held by foreigners outside the United States? What do you think is next for inflation?
Those are big topics, and I'll try to address them as simply as I can. And of course, I'm not claiming I have a crystal ball that I know where inflation's going. But in general, as you said, the central banks around the world, the four main central banks, the U.S., China, Japan, and the European Union, they've pumped in $20 trillion in basically new money into bonds and stocks. And that's been, as we say, quantitative easing, QE. That has boosted the equities and bond markets tremendously. I mean, basically, the U.S. stock market has tripled in the last decade. And so for those people that own that and corporate insiders, and then they've done very well with that. But as you say, very little has trickled down. And we also have to make mention of the fact that the Treasury and the Federal Reserve also put about $20 trillion into saving the U.S. Banking sector back in the global financial crisis of 2008, 2009. So trillions and trillions of dollars have been poured into the financial sector. So, of course, it's responded by doing very well, but for the rest of us, we're still borrowing money, on credit cards at 18% or an auto loan at 6%. So we're not getting the 0% money that the lenders are. So how does inflation work? And we say, well, we have inflation in assets because you put in the 20 trillion, you're going to get inflation somewhere in the system, and so because that's a lot of new money chasing the existing pool of capital or goods and services. And so we've had asset inflation. So the stock market's tripled and bonds have done very well, and real estate's doubled or even tripled in certain parts of the U.S. So we've got inflation in assets, but we haven't had inflation in the real world yet. But I want to make a point that I try to explain in my blog quite often, and you guys have probably covered it as well, which is inflation is also uneven. It's kind of like the wealth in the U.S. There's a divide in inflation. Say, take healthcare. If you work for a big employer and, you might have seen your copay go up a bit, but you're not really paying the full freight. You're not paying the full cost. And so you're not really seeing the incredible inflation in healthcare. Whereas if you're self-employed and you're paying the full sum, which is rising by several $100s a month every year, then you realize, wow, inflation is just soaring in certain areas. And so if you have a child in college, for example, college tuition and fees have been they're rising at 5 to 10% every year. And so when you're told inflation's 2%, you go, well, not in my household. So we have to differentiate that, and that's where our statistics for inflation they're basically still stuck in the 1950s. In other words, they don't really reflect the U.S. economy as it is now. That they basically take a basket of goods around the whole U.S. and they kind of lump it all together and they come up with this magic 2% inflation. But I think it would be a lot more accurate if we actually broke out all these different categories and said, if you have a child in college and if you're paying the full cost of healthcare, then your inflation rate's 17%. Wow. Then we'd have a more accurate response. But back to the other point is, how does inflation happen? It's a lot of new money chasing the same pool of goods and services. That's what inflation is. And so it's a reduction in the purchasing power of your money. And so if people do instigate this universal basic income or any of this kind of attempts to mitigate wealth and income inequality by just sending out everybody $1,000 a month, then we're going to get real-world inflation, because you can't pump $1 trillion or $2 into the economy that people are going to spend and not have some effect. And we also want to mention very briefly that, globalization, as we all know, has created a pool of very low-cost goods, right? In other words, the offshoring of U.S. manufacturing and also from Japan to China has lowered the cost of a lot of things like T-shirts and athletic shoes and electronic components. And so if the trade wars kind of heat up or the tariff wars heat up, then we could see that that globalization effect go away. In other words, prices will rise as industries, reshored or brought back to the U.S. or other currency disruptions occur that cause our imports to decline, and we get, instead of cost savings from importing stuff, we see price rises. So I think we have to anticipate that after decades of low inflation, that we could look ahead and say we could get high inflation, and that could really impact investments, right? Because only certain investments do well in high inflation, and a lot of investments lose ground. And I'm sure that's part of your report.
Now, Charles, following up on this topic, the national debt is held in large numbers by other countries, and the federal government owes money to many Americans as well, but it's lending exposure to nations. What is the cure to this? Are we going to see a postponement in retirement age or scale back in entitlements? Warren Buffett seems to think the opposite, where more money will be paid to displaced workers, sort of a universal income like you were talking about by taxing the rich. Or will we see the United States continue to become enormously wealthy, concentrated by fewer people? What are your thoughts about that?
Well, that's a very important topic, and I'm glad you brought that up. And, if you look at the debt numbers, a lot of people have been look at it with complacency. In other words, the U.S. government borrows money every year running a deficit, and corporate debt's rising and household debt's rising, but, student loan debt's rising, but, it's okay. We've been... we're doing fine. In other words, the economy's booming because everyone's borrowing all this money. But other people, and I tend to be in this camp that's concerned about the amount of debt that's being piled up because, as we all know, interest accumulates on all debt, and just because the rates of interest are very low right now on Treasury debt and corporate bonds doesn't mean that it's always going to stay low, right? I mean, the world is always changing. You can't count on anything to last forever. That's what history suggests. So right now, it seems like affordable to have. We have about $70 trillion in total debt in the U.S. That's including the federal government debt of about $20 trillion, and then corporate debt and household debt. And that's a big number when you consider that GDP is about $20 trillion. So we're talking about 3.5 times more debt than we have the size of the economy. And so you have to look back at the recent history of the U.S. economy, and people, young people weren't even alive in the 70s when inflation was started kicking up and becoming a serious issue. But a lot of people that look at these long cycles say that nothing stays the same, and so we've had a generation of very low inflation, and it's possible that we'd have the next generation would see higher inflation. As far as the U.S. dollar, you're right; it is a global currency, and it is the world's reserve currency is what they call it, and which means that it's the currency that everybody can go to and know that it has a stable value, and they can count on it having more or less the same value tomorrow as it has today. And that's not the case with smaller currencies, which fluctuate. So we do serve two markets, if you will, with the U.S. dollar. We have a domestic economy, but we also serve the global economy. And so, and this, of course, matters, as we all know, because if our currency, the dollar, goes up in value compared to other currencies, then we can buy more oil for the same money, right? And if our currency loses value, then all those things we import, including oil and other components, they go up in price. And so that's where it gets really complicated when you start looking at the value of your currency and then inflation. And so for countries, as we all know, there's a lot of emerging markets which are suffering huge declines in the value of their money, right? Their purchasing power of their currencies dropped significantly, and so that means they're paying a lot more money in their domestic economy for anything they import. And so that's disrupting their economies and creating tremendous recessions. So back to your question about, so where does this all lead? The topics we're talking about here, globalization, the financialization, QE, all of these, and the rising debt, they have concentrated wealth and income in the top, top, not just 1%, but top 0.5% or even 0.1%. And they've sort of left behind the bottom 80% of American households. And so the idea that we can just tax the rich, the problem there is if we got high inflation, typically stocks and bonds do very poorly in eras in which inflation is rising. And so maybe these very high valuations for stocks and bonds that have made a lot of people wealthy, if that sort of declines or stagnates, then the idea that you can just tax everybody because they're so rich, that might not work either. So I'm not sure if Warren Buffett's idea about universal basic income, an idea shared by a lot of really wealthy people, that works fine as long as stocks and bonds and real estate stay at the current very high levels. But if those were to decline, then that plan becomes a little more iffy.
Sure does. It sounds like Venezuela, doesn't it, Charles?
It does.
It was a brilliant idea 10 years ago in that country until today. Staying with the globalization theme, what is the term predatory globalization?
Yeah, that's a term that I have used in my writings to describe that it's the kind of globalization that we experience now is not the classic beneficial globalization that we were taught in school, like at Economics 101. It's called comparative advantage, and the idea there is that we're really good at making one product, and somebody else in another country is really good at making another one, and so we trade those two, and we both benefit from it. But predatory globalization is where those countries or corporations with access to a lot of cheap credit can go in and they can go into a smaller economy and they can buy up a lot of things like mines, oil wells, that kind of thing. Beachside condos and so on. And so they can disrupt and actually really hurt that smaller economy because they've got access to cheap money that the local economy doesn't have. In other words, you go into some developing world country, they don't have the Federal Reserve, giving them basically unlimited amounts of money at 1 or 2%, like the U.S. lending and corporate sectors. So then it becomes predatory. It's not beneficial. Somebody's losing and somebody else is gaining. And so the globalization is okay if it's win-win, but the version we have now is largely win-lose. There's a loser to globalization, and that's partly, as we were talking about, why there's a wealth divide in the U.S. is that for those people who have benefited from globalization, like the shareholders of Apple and so on, it's been a great ride the last decade of imbalanced globalization. But for everybody that their town was devastated by the closing of all their factories, then they got offshored to China, then that has not been a success. There's losers. And I think in general, we don't like to look at that because it's uncomfortable. We like a win-win situation. That's the American way, and so it's difficult for us to look at a situation where there's winners and losers.
Charles, do you believe that there is a revolution or a paradigm shift in the way that Americans trust their government and their media sources because of all of this happenings right now? Or are the majority of people still sort of habitually following the mainstream?
That's a really interesting and, of course, controversial question because many people, of course, are worried that the alternative sources of information or opinion are so-called fake news, and that they're disrupting the conventional mainstream news, which is reporting the, quote, truth. And so a lot of people are doubting everything. And that's, some skepticism is always a good idea. And I think, in my view, you don't want to suppress healthy skepticism. And if you won't let anybody question things, then you're not going to get to the bottom of the issue. And we've been talking about statistics, and of course that's part of the issue here. Is it's not necessarily fake news or a conspiracy or anything, but a lot of the doubts that many of us have about things like government statistics is maybe the statistics just are outdated. Maybe they just don't reflect reality anymore because of the way they're assembled. And so, like we said, the inflation rate is 2%, but that doesn't seem accurate if for a lot of us. So that's part of the issue. Is our government and our institutions, are they presenting statistics that have been either manipulated to reach a particular goal, or are they just so outdated that they're questionable in terms of their accuracy? So I think there is a revolution in the sense that people feel that they're being told the economy is running running hot and great, and it's like the best economy ever, and blah blah blah. But their own personal experience doesn't align with that. They're not doing better. Their wages are stagnating. They don't have capital that's doubling and tripling in value, and so that's the main source of the skepticism about the narratives, if you will. It just simply doesn't align with the experience of many Americans now, and so of course they're questioning it.
Now, you wrote an article about the telltale signs of a declining empire, which is a fascinating topic. Can you please share the highlights?
Well, thank you very much for that. I tend to go on and on about that, and I'm not the only one, of course, who looks at the Roman Empire and some of the dynasties in China that we have a lot of history and archaeology to support, conclusions. In other words, these aren't just random opinions pulled out of a hat somewhere. I mean, this is based on archaeological evidence and the records that we have from those ancient societies and empires. And what people have found is that there's a sort of a psychological or social change. It's not just the economy weakens because of a war or something like that. Of course, there are those issues, pandemics, wars. Those, of course, disrupt countries and empires and cause their decline. But there's also like a social change where people become, they're no longer willing to sacrifice for the common good. It's all me, and maximize, my personal wealth. And so the example in the Roman era, which of course the Roman Empire had a long history, hundreds and hundreds of years, and so at the beginning of the Roman Republic, and even in the early imperial era, the leadership, the senatorial class, the really wealthy, the political leadership, they had to sacrifice. They had to serve in the army. And they actually had to lead their troops, and so they could be killed in combat. And in fact, a third of the entire Senate was killed in one battle in that era when they were battling Carthage. And they also had to spend their own private wealth on public buildings and so on. And so there was a sense of sacrifice was required to qualify to be a leader. And then at the end of the empire, nobody was sacrificing anything. Nobody served in the army. Nobody led any troops. Everybody was just trying to get as much as they could. And so that's where a lot of people feel like, wow, maybe in America we're following that same path where our leadership seems really into self-aggrandizement and shady deals, some kind of, if not corruption technically, then certainly corruption in the sense that, the revolving door where the government employee goes to work for the lobbyist as soon as they retire, and that kind of thing. So that's where people feel like our social fabric or our social contract is fraying, and that's the path that we recognize in history that other nations and empires have followed. That the social fabric and the sense of willingness to sacrifice for the common good decay and go downhill.
What's that famous saying? If you forget history, you're destined to repeat it.
Right. Yes, that's true. And you talked about the great wealth of the U.S., and it is true that we have tremendous wealth, but as you said, it's imbalanced. It's asymmetric now. That so much of it is in the hands of a very few individuals, speculators, and corporations, and very little is trickling down. And then we're seeing a loss of social cohesion that we were just speaking about. That people feel that the country is no longer working for them. That they're not really enfranchised by this. They feel disenfranchised and marginalized in their own country, and that's the disturbing part.
Charles, this has been an amazing interview. It's been so wonderful to have you on this show. Where can everyone go to follow your work? And please tell us where to find your books.
Well, thank you so much. Visit me at of2minds.com. I have free chapters of my most recent books and a lot of archives of my articles. And you can find all my books on Amazon.com. Just search for Charles Hugh Smith.
Charles, thank you so much for joining us today.
It's been my pleasure, Michelle, and I hope I didn't ramble on too much about my favorite topics.
Oh, no. It's been very, very interesting. Mr. Charles Hugh Smith, author, YouTuber, and the blogger behind of2minds.com. For the Leaders of Tomorrow's show, I'm Michelle Holliday at PortfolioWealthGlobal.com.
Steve St. Angelo of SRS Rocco Report, Mickey Fulp on gold bottoming, Mark Faber on bear market preparation, Andrew McGuire on gold-backed cryptocurrency, and many more recent interviews are available on the channel right now. To stay up to date on Tom Beck's intensive research with his team on the general markets, dividend plays, cannabis stocks, blockchain companies, and precious metals under the radar opportunities, make sure you are a subscriber of the flagship free newsletter at PortfolioWealthGlobal.com. Thanks for watching.